learning just as much as you guys are, okay? But that still doesn't mitigate the importance of it, all right? So what we have today is going around is Hansen and O'Connor is an accounting firm, and this is a father and son team here. Minus Mr. O'Connor, right?
Captain, yeah.
Yes, okay. So he's not here today, the O'Connor side, but we do have the Hansen side. They were recommended by Pat O'Connor, who is Pat Carroll, who is our insurance chief with the Country Life Insurance, and they provided insurance coverage for farm and family for a long time, for many, many years. That's who we have as our organization insurance insurer. So when we were looking for people who actually were farmers or who knew about the farming side of accounting, the Hansen firm or family came up, and so we're so glad that they agreed to be a part of this project, okay, and share this information. Do you all have any flash drive or anything that needs to be?
Yeah,
it's already in there, so you have it up and running? All right, without further ado, I would love to put them before you, and so let's get our books out. That's what our books are about. Take notes, and let's listen. Thank you.
my name is Andrew Hansen. This is my father, Arlen. And let's see, I've been in this for 5 years. He's been in this for 36. So we have a lot of experience with taxes, tax problems. We're also farmers. Together we farm about 440 acres of corn and beans. Right now that sucks. Because we got, I think this last week, we got about 6 inches of rain. When we just stuck in our corn, so we stuck in about 220 acres of corn. And then, let's see, cold weather and wet weather. That's not good ingredients for making our corn grow up. So we're thinking that we're going to have to plant at least, probably maybe 15 acres, I would say. Which never does as well as the original stuff. So initially we're going to start off talking about farm accounting, but maybe only a tenth of our business for our accounting firm is just farms. It's individual stuff, people that work on W-2s, that type of stuff. We can talk about that later, but initially we'll start talking about farm accounting. There's 3 main forms. Number 1, let's find out what you guys do so we can sort of individualize our discussion. We're used to not talking to people like this. We're used to talking to people just across the desk and being able to individualize our conversations, our recommendations, stuff like that. So from your website, it looks like most of you are vegetable farmers. Yeah. Any livestock guys in here? No animals? Yeah. We got some animals? Okay, what kind of animals do you guys have?
Cows, chickens, goats.
Cows, chickens, goats? Okay. And then, but everybody else here is vegetable farmers? Chicken? Pretty much. Okay. Vegetable or fruit, stuff like that. Vegetable and fruit would be about the same for accounting reasons. So let's start you off with just some main forms that we use. The Schedule F, that looks at active participation in farming or fishing industries. We got the Schedule 4835, that's crop share. That really wouldn't deal with too much vegetable farming. And then Schedule E would be like cash rent farm, stuff like that. So most of you, if you're actually sweating to produce an income, we're probably going to be looking at the Schedule F for you guys. How do you guys sell your crop? Just at farmers markets?
Direct sales, farmers markets, some wholesale.
Some wholesale.
Yeah.
Okay, but we're actually going someplace and we're actually selling stuff to somebody else, right? And taking in revenue? Okay. Because we want to make sure that if we're just planting, say, lettuce, like I think we still do like tomatoes, lettuce, green beans, stuff like that, just for personal use. The IRS does not let us deduct expenses for personal use items. So if we're just growing a small garden that we're just going to eat ourselves, we can't take those expenses. But if we're growing stuff to actually sell, to make some money, then we're going to include those expenses and everything allowable for expense-wise so we can offset some of that income. So personal use, one of Pop's main thing is that a lot of our active farmers have is a separate checking account. Most of the time it just goes your name and then farm account. That way we can make sure when we separate between personal expenses and business expenses. Because if you actually got audited, it's easier to sort of
segregates the expenses and the income from those. And if you borrow any money, if the IRS can determine that you use some of that for personal expenses, they won't allow us to deduct that interest. And so on some of our grain farmers and stuff like that, what we have them do is we have two separate accounts. If when they sell grain, we actually have them fund the household account and put the proceeds from that. And then if they need to borrow money, all money is borrowed for his farm expenses. And that way the interest that's coming off that is going to be fully deducted.
Is it always the law?
Pardon me?
Is it always the law?
oh no. Well, grain farming, that's probably 7 years. Ever since corn went up to, I think, once it pushed over 5 the first time.
I don't.
I mean, our farmers are some of our biggest returns, really.
Right now.
Yeah.
But we want to keep in mind, in November of 2012, price of corn was around $7.60. In 2013, that was $4.03. It cost according to government, it cost you $4.30 to raise it. So you can see that situation, that curve is going down. And so people, bankers that I've been talking to, the guys they haven't talked to in 3 or 4 years are talking to them now, trying to get money lined up to put this year's crop in. So a lot of that money's been put into either land or into new iron. And so we always say the farmers are dirt poor. In other words, we own a lot of dirt, but we don't have much cash. And that's because we invest in this. And so it's not highly liquid.
Now, as far as the farm, is that a business, or do you have to have a business number and all this stuff?
No, not really.
Yeah. On just the Schedule F, it's just on your personal, your individual tax return. Right? It's just stating that you're in the farming or fishing industry, and then we get a little bit, farmers get special rules from the IRS that most individual people don't get. So that's really, it's not like a separate corporation or a separate
Like if
partnership.
you got a business tax number, does that?
If you have it, that's okay. But you really only need an EIN, an employer identification number, only if you employ other people. So if you're doing W-2 wages, you don't really need an EIN if you're just working for yourself.
The self-employment tax form that you'll file will be strictly under your Social Security number.
Are we talking about future crops or crops in the ground now? When you file your income tax on the...
You're on a cash basis, so you would only file that after you derive the income. So in other words, you'd have to have the harvest. The biggest thing is when you start planting that crop, you need to start keeping track of those expenses. You don't want to wait till the end of the year and have a whole big pile of deals to go through. So the idea is you don't have to get real fancy with it. I mean, some people come in with a computer program and stuff like that.
And then some people just stick the receipts like what Johari had for the envelopes. They just stick the receipts in, and then say in January, February, we just go through a form.
Okay.
So, but the biggest thing is keep track. I mean, we can't make up the stuff for you. And then a year later, it's hard to remember, did I travel here? What costs did I have here? That type of stuff. It's always important to keep track as you're doing it. It's so much easier.
Well, there's so many people that come on in and they say, these are all my expenses. Well, many little figures are a lot more preferable than one big figure. You can't just say, oh, these are all my expenses. We need to have it broke down between your pairs. And he's going to hand out a worksheet later on showing how to break those down. That we need a lot of small figures to make up that big number. They need to know where it actually went to.
Because we got small farmers that it's smaller numbers, but then we got big farmers where, say, 10,000 is a small number for it, but it swings a heck of a lot. So just saying, it's around, say, $500. Well, is it $500 or is it $575? If you're doing that the whole time, $75 over that whole thing makes quite a bit of difference.
Mark Lerner used to always say, nothing ends in zeros. Everything's too is nothing is $100, $50, $500. It's usually $513 or whatever. So.
So whenever we have to estimate expenses for someone else, it's not always, we never end in zeros, because that shows the IRS that we're estimating.
You're not doing nothing.
They're gonna pick it out.
Right.
So we always go, if you're saying 500, we're gonna go like 498 or 507, something like that. Because it's a lot harder for them to prove that we're estimating.
But if you went in through an audit, and
Yeah, oh, yeah.
you was able to say, bing, 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 these are the receipts that made up that number and it came out right, well, can you think of anything better and more impressive to an IRS agent? You know, you come out with a deal and you put down $500 and you only came out with $375, he's going to suspect every number you got because you're overestimating on that, and why would you overestimate on the rest of them? You know, so it's building a little bit of trust in your record.
Well, we best.
You'll see on the left side is all the expenses, the different types of expenses. On the right side is all the different types of income that we have.
But we've had different variations for, 30 years of this worksheet. And we get some people that don't use this at all. We get some people that must have this all the time for every year because they group everything real nice for us. And it gives us a little bit more idea what kind of expenses we should be keeping track of, that type of stuff.
I have a question.
Yeah.
You said that there's advantages to farmers?
Oh, definitely.
As opposed to say if I made $1,000 on my job or $1,000 on my farm, what's the advantage one over the other?
Now, one of the main advantages is, number one, we don't have to make estimated taxes. If you're actually considered a farmer, which means 2/3 of your gross income comes from farming. So we look at, say your total product income is $50,000, just gross, not net. And you don't have any other income besides that. No pensions, no IRAs, no Social Security. Then you're classified a farmer. So where normal people, they got to either pay 90% of this year's tax or match last year's tax in order not to get interest and penalties, sort of accrued on them. Where farmers, as long as they pay their total tax due by March 1st, they're free of interest, of penalties. Where most people, like the state of Illinois, is horrible because they charge about 10% of any tax that was owed them during the whole year. We can sort of, as long as we're classified a farmer, we can get away from that interest. We'll see big letters coming on later about people that say owed Illinois $3,000. We pay the $3,000, but Illinois will come back with us saying, well now, heck, you owe another, say, $300 just because of interest. You should have paid this to us regularly throughout the year. Farmers don't have that. As long as they pay their total tax due by March 1st, they're free of that interest. But you got to be classified a farmer to do that. And then the other main one that we love is income averaging. There used to be an old rule for normal people.
1985 we stopped that.
They stopped that. But farmers kept going along with that. So, for example, say in the past 3 years, so for 10, 11, and 12, for tax year 10, 11, and 12, we had real low income. So say we're in the 10% tax bracket on the Fed. And then in 13, all of a sudden, we're in 25% land. What income averaging lets us do is move some of this 25% money into the past years and shift it into, say, 15% land. So we're saving 10%. Normal people can't do that, but farmers can, as long as you're classified a farmer.
Well, what are the classifications of farmers?
Well, 2/3 of your gross income must come from farming or fishing activities. Right.
Yeah, fishermen are also qualified with that. Farmers and fishermen, we don't do too many fishermen.
No.
As far as, where they're commercial.
Right.
That's more on the East Coast and stuff like this. But for around here, farmers basically are the only group that qualify.
But it goes on gross income. So they don't care what your net is. We could have a loss on the whole thing. But if your gross is, say, $100,000, and you don't have, say, maybe you had like $10,000 through IRAs, pensions, or other W-2 income, you're classified a farmer. So then you can start doing that income average.
Question.
Yeah.
Farmers have to deal with capital gains.
Oh, everyone has to do
state, 5 cents on the dollar. If you are in a 25% or higher bracket, then the rate is 15 cents on the dollar. So, and you're saving at least 10 cents on capital gains on the federal return at the minimum. So capital gains, when everybody asks, "Well, I gotta pay capital gains, that's terrible." No, that's a good thing. That's really
It's actually a tax break.
Yeah, that's
See,
a tax
are you
break.
married, Tom? Oh, it's her, okay. Congratulations.
You got lucky once in your life.
Okay, so married filing joint last year, the break between 15 and 25% land was $72,500. That's line 43 taxable income. So after we take off, say, itemized deductions, if you have real estate tax, mortgage interest, high charitable contributions, stuff like that, after we take that off, we get the taxable income line, line 43. That's the line that decides what tax bracket you're in. So if you're, say, at 50,000 for your taxable income, I mean, all capital gains, any long-term asset that you've held for over a year, so we get long-term capital gains rate, you don't have to pay anything on it. So if you have qualified dividends, long-term stock sales, stuff like that, or really farmland, but most of farmland will bump you over. But if you have small stuff like that, you don't have to pay any money on it. You still have to pay 5% on the state. They don't care whether you're long-term or short-term. But for the Fed, it's very crucial that, if we're a day away from being short-term to long-term, hold it for another day. The stock isn't going to drop that fast. So long-term, no, capital gains is a great thing.
Long-term is how much?
A year, over a year.
I mean, how much is the tax bracket?
Well, long-term,
15?
it's the difference between 15 and 25% land. So if you're a single person last year, let's see, that was 36,250. So the break was 36,250. So if you were at, say, 40,000, you would have to pay on that difference if it was long-term stock sales or qualified dividends, stuff like that.
The biggest thing you have to keep in mind is 36,000. Most people think they start adding up their W-2 and stuff like that. But just like he said, you're able to take off on a married filing on a single return about $6,100 plus you get $3,900. So you take whatever your income is, subtract 10,000 off of that, and that has to be, if you're then for below 36,000, we're in a 15% tax bracket.
And then
So
all
it's
our
not
long-term
your income,
assets are
it's your income less all those deductions. That $10,000 minimum. And if you can itemize like that home mortgage interest and church and charity and stuff like that, if that's more than $6,100, you get the higher of the two. So if that number's $10,000 and plus they get allowed $3,900. So until we make over $14,000 above that 36, so really an income of $50,000 minus that $14,000 gets us down below that 36. At that point, we're down to a 15% tax bracket, and if you have capital gains at that point, then there is no federal income tax on that at this point.
John, I'm just gonna be a devil's advocate here. What's capital gains?
What's that?
Capital gains is any investment property, any type of stock, it's any type of land purchases that you held for more than a year. If it's short term, it's less than a year, that's just normal ordinary income. It goes right into just like your wages, the only thing you have to pay Social Security tax on. But it's just the technical term is any what they call Section 431 property, which is basically just any property that you don't for investment.
And really, if you guys have cattle, that also qualifies as a long-term capital gain if you sell it for more than what you bought it for.
Yeah.
So, like where you guys are doing vegetables, they sort of get different rules because they have livestock.
Yeah, and if they held a breeding stock, and you held it for more than 2 years on cattle or on horses, that you've held it for more than 2 years, then you get capital gains at that point. If it's less than that, then it's just ordinary. So they make it stretch it out a little bit on breeding stock.
But for you guys, your standard would be 12.2 plus your 7,800. So we say your W-2 was 70,000. We're taking off 20,000 just using the standard and using your exemptions. So I mean, heck, right there, we're well below the break between 15 and 25%.
So you put the crop in and it takes a year to get it out?
Well, no. Corn, beans, that type of stuff. Well, number one, a year, it's going to get frost. It's going to be dead by
If you
then.
take like you plant fruit trees and stuff like that, they have a term they call capitalization, but they say is once you put that tree in, and before it is able to bear fruit, it takes 6, 7 years, whatever it is. They really want you to do is take the cost of putting them trees in and all the cost of keeping them up until they bear fruit. You sort of just capitalize it. In other words, you just sort of collect that cost. You can't deduct it in those years that you spend it. You hold it until you start producing income. At that point, then you start deducting the cost of that. So you hold that cost until that time.
So you're saying that's not considered an expense? So if I put, $3,000 this year into fruit production,
right,
I can't use that as a farm expense for this year?
For this year, right?
You would just keep carrying it over till you actually start selling it, start making money.
Yeah.
Because they really want you to match up income with expenses a little bit.
I see.
Now we do have, I think, a guy up north that has a cattle herd that we've been depreciating sort of his capitalization of his herd through supplies, major supplies, stuff like that, but he hasn't started actually making money on it. But, I mean, there are certain instances where we do start taking a little bit of the cost.
Good for two reasons. Number one, you don't want to take, if you don't have a lot of income right now, you don't want to really take the deductions off, because you're really, whenever you take that deduction, you're sort of selling that deduction. So if we're selling that deduction or to the federal government in a way, because if you're in a 10% tax bracket, you're only getting a dime for every dollar you spend. Whereas later on, when we start the trees or the animals start producing income, they get to 25%. Those deductions then are worth 25 cents to us. So why would we sell it now when later on we're going to need it later on?
So it's considered selling back? Deductions are considered selling back to the federal government?
What I'm getting at is, when do we deduct the income? Do we deduct it when we're in a 10% tax bracket, or do we want to wait until the asset that we're putting that money in is producing, giving us 25% taxable income? We want to use it later on. Why would we sell it for, I call it selling it, why would we sell it for a dime when we can get it more?
Got it.
See, the biggest thing in your case, Jahari, is like we're going to take 3,000 of expenses now. So we got 3,000, 3,000, 3,000, and then all of a sudden we got our income this high. Well, heck, now we don't have any more expenses. We always we look at like depreciation sort of as a long-term viewpoint. You can take it all the first year under certain circumstances, but then later on you're going to pay for it.
Like dogs, they're not considered livestock.
Dogs. You're not using it for fur, are you?
No, okay.
Yeah. Okay, so let's look at...
Anybody you're selling stuff like that, you still have that breed stock, that is situation. So I mean, if you are really selling the pups and stuff like that, that's a business too. I mean, as long as we're getting income from it.
Is that into the farming business, or is that?
Well, actually, be a livestock. I mean, that's how they look at that. It'd either be a schedule. I've seen them put on Schedule C before. I've seen a Schedule F. But generally, Schedule C on dogs is what they do. But really, it's an animal, so that's what you're selling, But
For the actual publication, I don't know if they deem dogs, cats, stuff like that as actual livestock. They
don't count any birds, chickens, and stuff like that. They don't count that as livestock either. Yeah.
So let's look at our worksheet there. And let's look at the income. Really, for you guys, we're looking at, for us, our grain-based farmers, we're looking at corn, beans, wheat. Those three things encompasses most of our farmers. But when we're looking at you guys, we're probably looking at vegetables, and then for you girls, we're looking at cattle. What other ones do you have? Goats, sheep, stuff like that. And ducks. Okay.
What about quail?
Quail? Is that a bird?
Yeah.
It is? Okay. So for sale of livestock, now we got three different things we can do for sale of livestock. The main two groupings are breeding stock and not breeding stock. So for breeding stock, when you guys would buy a cow that you're going to use to breed out, we take that cost that you bought it for and depreciate it over the lifetime. I think cattle is, 5 years? Okay. So we're going to appreciate, we either can use an election to Section 179, which means we're going to take, say, $800 what you bought for a cow, and we're just going to write the whole thing off the first year, or we can depreciate it over 5 years. That's for breeding stock. Now, if you're just buying a cow or a couple cows, and we just purchased them, not going to use to breed them, just going to use them to what?
Well, basically, what they used to call them feeders.
Feeders.
In other words, we buy them when they're small, we feed them out, and then we sell them for water.
Right.
And basically, we don't really depreciate the animals. We hold the cost of the animal until we sell it. In other words, we got $1,000 or say $1,000 into it, we can feed it ourselves for retire right now. Beef is selling pretty strong right now. So if we feed it out, we take off in the year that we feed it out, we take off the cost of the corn, the feed, and any other expenses that we have. And then we hold that $1,000 until we sell that animal. And then at that point, you can actually take it off. And that's why if you look at your deal up here at the top, it says cattle, let's see, it may not have that. Down here, it says sale of livestock purchase, not breeding stock. They want to know when you bought it, and the description, sale price, and then what your purchase price was. And then we're just going to pay on the difference between what it cost you versus the other. But you've already deducted all the expenses of raising over on the left side of the board.
So we're still going to deduct whatever you feed them, like the corn or hay or whatever you feed to them. We're going to deduct that every year. It's just that we're going to hold on to that purchase price, and that's where record keeping is crucial for you guys. We got to hold on to that purchase price, and then when you sell it, say you sell it for $1,500, but what you bought it for was, say, $1,600. Well, we're going to use that $1,600 to compensate for that $1,500 that we sold it for. So we'll have a small loss possibly on that.
Now, when you go to have baby goats and stuff, what is that? There's no cost in that.
Yeah, exactly. But still, if you breed those animals that you raise out, you still get capital gains on those if you help them long enough. And the reason why you want to do that, even though you don't get a deduction right now, it goes on to form a Schedule D capital gains if we sell it as a profit at a profit here. If you take that to the capital gains, we don't have to pay supplemental tax. It saves us about 15 cents per dollar. If you just buy an animal and then you sell it out and just raise it like that, that's subject to self-employment tax. And that's 15 cents in addition to the tax bracket at that time. So run it if you have a lot of income. Now we've got some people that it takes a long time before they make any money on it. And we sort of need the income to offset that. We sometimes will, throw the breeding stock in there just to bolster so that they don't look too ridiculous on the Schedule F. To be honest with you, though, how it's supposed to be rated handled is goes through the Schedule D, and then we end up not having to pay Social Security tax on it, which is saves us 15 cents on it.
So what you're saying is, when you put it on the income tax schedule D, it's just basic. When you start getting money for it, you're in another tax bracket altogether.
Well, the Schedule F is where you're going to operate. Okay. It's just if you have breeding stock that the Schedule D comes into play. And that's where then capital gains can actually save you some money on, depending on if you got capital gains. I mean, the only way that, like, they would get capital gains on that is if they bought it for $1,500 and sold it, say, for $2,000. Only that difference, that $500.
But it's a raised animal. Automatically have
Right.
Well, you're talking big time farm.
No, you're not. You're not really. No, not really.
Ten goats.
If you use them for breeding stock, the difference, if it's a raised animal and you've held it for more than 2 years and bred it out, and you sell that animal, everything, because you don't have any cost basis, just like we talked before. You don't have any cost basis, so $1 starts out as capital gains at that point. You'll be able to depreciate that thing. And so it does save us some money. Generally, you don't get much for cows and animals after you've held them for a while. The price goes down. I mean, it's like buying an older animal isn't worth as good as a newer animal. You're not going to get that many calves out of it. That's what we're
Okay, and then other income that we have from the grain side is custom hire. Anybody have a tractor here? No? You have a tractor? Okay. So, do people hire you to till up their gardens or anything else?
Not as yet.
Not yet. But if they would, that would be on the Schedule F as well.
I had a guy last year and this year. This year I paid like $150 per acre to do, so I can put that on my.
As an expense, definitely.
Yeah.
Right. And you're really not required to send them a 1099 because it's not over $600.
Right.
See, once we get over $600, we're required to sort of give that person a 1099 for their service to notify the IRS that you need to be looking for $600 on the guy that's doing the work. See, everything is squealer sheets. You like to call them squealer sheets because it notifies the IRS of, this guy needs to have this document on his tax return, or this guy needs to have this document. But for you, if you're paying that out, it's very important to do that, because if they would ever audit you on that, they would probably disallow that, say, $700 that you would give that guy because you didn't give him a 1099.
Plus, there's a big fine issue with that, because he did send it to her.
Well, he might not say, well, since you don't put me on taxes, I don't know what to do with
Well,
it.
that's it.
But then make sure you're under $600.
Then you have his wife, right, a little bit. To be honest with you.
Just split them up between them.
Yeah.
Like from the grain side, we have a couple people that are still in CRP. That's what we call government program payments. It's where the government will give us like such and such an acre, not to do anything to it
Well,
for conservation.
that's why the lady that was running the deal is talking about getting the FSA number. If you qualify for any program, you will get a statement at the end of the year, and you will have to report that, because they'll send you a square sheet too. And if you don't show that on your tax return someplace, they're going to come ask you.
Oh, one more thing before we go further. What about these grants you get from, if you get a grant, how do you look around there?
There's no free money. Generally, if you get something off of the FSA, Foreign Service Agency, they generally give you a 1099 at the end of the year. CRP, any type of, if they come in there and fix up your grounds for drainage and stuff, there's a 1099 will come out on that. You have to deal with that. Now, generally, you have an offsetting deduction because you hire somebody to go do that work. But like CRP and stuff like that, they're going to send you a square sheet on it. You better get that down there, or else they're going to ask you. And see, they always work 2 years behind. So they give you enough rope, but during that time, they charge you interest on it. So
like when I was saying about 9% on Illinois, we're getting letters from 2011 now for some of our people that didn't report certain stuff. Well, that's why they let those 2 years go by, because now we're looking at, well, heck, they could have notified us right away. But now we got 18% on our money that we owe them, that now we have to give them, because we didn't report it. But that's why they're always working 2 years behind.
But it's always a little harder. Say you didn't report anything on your farm income for the year, and the FSA had sent you that deal. Then that brings up the deal of, it looks like you're coming in through the back door when because they caught you, now you're going to report it. That's not as good a program as if you had it down to start with. Because it looks like, it's only because I'm caught that I report this.
And the first step is the IRS notifies you, and once you get that resolved, and you sort of got that weight off your shoulder, and you take a deep breath, then they go ahead and notify Illinois. Then you got to deal with Illinois.
Because see, Illinois really doesn't check anything out. They depend on the federal to let them know if it's either yay or nay. If the Fed says this, they don't have really, Illinois is a very poor investigation. They always are dealing off of the federal. So, we've got them, here's the deal, and they send it on down, now you get it. And that's why if you file an amended return, you always have to file the federal first. That has to be finalized before you send that state return in, because the state won't honor anything unless it's A-OK. That's why you always have to wait.
Then crop insurance, do you guys have crop insurance on anything of yours?
Yeah, I need to know that.
Okay. And then gas tax refund, for us, for our farming corporation, we have like Heritage FS come out and give us diesel and gas and that type of stuff. So we don't have tax on that
most of our